one of the biggest misnomer in our industry is calling fixed income a risk-free or safety portfolio. If you think about the average volatility of a long US Treasury bond portfolio, it could be as high as 10%. You think about developed market government bonds plus in the currency fluctuation, it could be well in excess of 10% per annum. So bonds are not risk-free, and certainly in the last 2 weeks we've seen that's the case. Bonds have fluctuations and it can lose in value quite significantly over a short period of time. So I think we need to dispense with the notion that bonds are the safety portfolio. With regard to traditional asset allocation, where we have a split between equities and bonds, again, that is way too concentrated in fixed income risk and in equity risk. Investors are well advised to think of diversification outside of the traditional stock bond allocation and into things that are perhaps more unfamiliar, less conventional, but in doing so you actually improve portfolio safety because of the natural diversification benefit, and also because these asset classes are less comfortable, less familiar. They tend to have more premium included because it's not as crowded of a trade.
So specifically, what do you have in mind when you say that?
I would say diversify into commodities, diversify into emerging market local currency bonds, emerging market equities, diversify into listed real estate. All of these asset classes will give you additional benefits in terms of risk-return trade-off.